Welcome to The Explainer. Today, we're digging into the market action from December 5th. The Santa rally is absolutely in full force, pushing the markets into record territory. But the real story today? A massive industry-shaking deal that has everyone talking. Let's get right into it. All right, so you're seeing the headlines, all-time highs. Investor optimism is through the roof. But you have to ask, what is really fueling this powerful year-end rally? And maybe more importantly, are there some cracks starting to show just beneath the surface? That's what we're going to find out. At a glance, the big picture looks fantastic. You can see both the S&P 500 and the Nasdaq pushed even deeper into record territory. It was just a strong, bullish day all around. This is the kind of momentum that's really driven by pure optimism, with everyone hoping for a strong finish to the year. So, what's pouring all this fuel on the fire? Well, it really boils down to two huge catalysts that hit the market today. One came from the corporate world, and the other from the wider economy. Okay, first up, a blockbuster deal. We're talking about an M&A announcement that is completely shaking up the media landscape. Seriously, this is everyone wondering about the entire future of streaming. Get ready for this number. $720 billion. That is the jaw-dropping price tag on Netflix's deal to buy Warner Bros. Streaming and studio assets. A deal this huge sent shockwaves through the market and made the communications services sector the day's absolute top performer, jumping over 1.2%. And the other major driver today, a healthy dose of good economic news. The core PCE inflation number, which, is the Fed's favorite way to measure inflation, came in right on target. That calmed a lot of nerves and really strengthened the case for a rate cut in December. Then you add in the first rise in consumer sentiment we've seen in 5 months, and boom, you've got the perfect recipe for Wall Street's favorite story, the soft landing. But it wasn't all sunshine and roses. What's really interesting about a day like today is what happens when you peak just below those big, flashy headline numbers. That's where some potential warning signs are starting to pop up. We're seeing what a lot of analysts call a market divergence. So while the huge companies in the S&P 500 are flying high, the smaller companies in the Russell 2000 are actually getting left behind. They finished the day in the red. It's a pretty clear sign that this rally might not be as healthy or as widespread as it first looks. So while the party is raging in the large-cap stocks, there are some storm clouds gathering elsewhere. Bond yields are creeping up again. The 10-year Treasury hit 4.14%. That makes safer investments start to look a little more attractive than stocks. And at the same time, geopolitical tensions are on the rise, with a new bill threatening to block key chip exports to China. These aren't just little things. These are some pretty major headwinds building against the market. So how are the pros making sense of all this? Well, as you might guess, Wall Street is pretty split. There's a really clear debate forming between the bulls and the bears. In one corner, you've got Rick Rieder from BlackRock. He's looking at the job market data and basically saying, hey, things are slowing down. The Fed needs to step in and cut interest rates, and they need to do it soon to keep the economy from stalling. But then on the complete other side of the spectrum, you have a longtime bull, Ed Yardeni. He's got a super optimistic outlook, betting big that the transformative power of AI plus a little government spending is going to launch corporate profits and push the market to incredible new heights next year. And then you've got the more, let's call it the nuanced take from David Kostin over at Goldman Sachs. He's essentially saying, hold on, don't just buy everything. He thinks you need to be selective. Look for value in some of the overlooked spots, like healthcare, and focus on companies that are actually using AI to make more money, not just talking about it in their press releases. So where does all this leave the average investor? Well, the Fear and Greed Index tells the story pretty clearly. The needle is pointing firmly to greed. It just goes to show you that despite all the risks we just talked about, most investors are feeling pretty bullish and optimistic right now. And that feeling is backed up by the VIX, which people often call the market's fear gauge. It's sitting at a very low level, which reinforces this sense of calm. Now, while that's great for the Santa rally narrative, some of the more cautious folks out there might call it a sign of complacency. So what in the world does this all mean for you? With all these competing signals flying around, let's break down 2 potential strategies for investors based on today's pretty complex market action. I mean, just look at today's biggest movers. They really tell the 2 different stories playing out. You had Ulta Beauty absolutely soaring over 13% on incredible earnings. That's a classic consumer strength story. But then you had HPE dropping because it had to delay its AI server revenue. It just shows how critical it is to get the big picture right because company-specific news is still driving these huge wins and losses. This really brings every investor to a crossroads. Path number one is the aggressive play. You lean into this momentum and chase that high-growth AI story. Path number two is the defensive one. You start preparing for some potential uncertainty by focusing on value and safety. Let's take a quick look at what each path might involve. Okay, so the aggressive path is basically a full-on bet on the AI revolution. You'd be targeting the infrastructure, the companies building the chips, the data centers. An ETF like SMH, for instance, is all about semiconductors. The big risk, though, it's all geopolitical. If U.S. regulations on chip exports to China get any stricter, this entire play could hit a major wall. Now, the defensive stance, that's all about getting ready for a potential slowdown. This means rotating into sectors that aren't so tied to the economy's every whim and maybe have better valuations. Think healthcare or banking. You can get exposure through ETFs like XLV or KBWB. But the big risk here? A surprise comeback from inflation, which could force the Fed to keep rates high, and that would hurt even these safer bets. When you boil it all down, today's rally shows that the market is pricing in perfection. It's betting on an absolutely flawless economic landing as we head into the new year. But all these underlying tensions we've talked about, from rising bond yields to geopolitical friction, they all point to one critical question. What happens if the market is wrong? That's the key thing to think about as we head into the final weeks of the year.